Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches, here on the sunny northern beaches of Sydney, and around Australia on the Community Radio Network, complements of the Community Broadcasting Association of Australia. This week, I'm really pleased to welcome to the microphone and camera a new face, a new voice, Jen Richardson. And Jen is an ex-financial planner. She comes from an area where I used to live in the Newcastle district. And Jen is going to be talking to us today around a whole range of subjects, but specifically super, because it's so topical at this point in time, but with a particular bent. So before we get into the meat and potatoes of the show, I want to welcome Jen. And Jen, maybe explain to the listeners a little bit about who you are and why you're so passionate about what you do.
Thanks, Ray. So I am an accountant and I have an accounting practice here in Newcastle. I'm a mortgage broker and, as you said, I'm a former financial advisor. I am passionate about women, helping them be better at their finance, because we have been told a narration over the years that women are not good with money, or that we overspend, we have no idea how to control our money. And it's simply not true. And so I want women to understand that taking control of their finances and their financial future is definitely in their control and definitely something that they can do. But like everything, it's a skill that you need to learn, not something that you were born knowing how to do. So a number of years ago, my mum said to me that her and dad's financial advisor didn't talk to her, and I had to explain to her the concept of what they were doing. And having that discussion with my clients in my accounting practice, so many women said to me, Jen, you're so lucky that you understand money. And it's nothing to do with luck. Yes, it is my vocation that I've chosen. But being an accountant is very different to being good with money, and there is no correlation there. I've seen lots of accountants that have gone bankrupt. I've seen lots of accountants that have nothing to show at the end of their careers. So it is a skill that we all need to learn, and it's a skill that, to be honest, I didn't even learn till I was in my 30s. My 20s were a red hot mess of finances. I lived on credit card. I was doing cash outs on my credit card because I had no idea at first that you even paid interest as soon as you did the cash out.
Ouch.
I came back from my honeymoon, and my new husband and I had $10 sitting in our account because we had spent it all. Because as an accountant, you're trained to look at financial statements, look at reconciling stuff, tax legislation. There's no budgeting and planning or anything involved in that training. So I set about educating myself. I made a lot of mistakes along the way, and I'd like to pass those things that I've learnt on to anybody who would listen. But I have a passion for helping women, because I think, as I said, we stick with that narration that we are hopeless with money, and we give that as an excuse. And of course, women have a longer life expectancy than men. We retire with less money than men. And that number just doesn't make sense to me, that we have less money that needs to last longer. And so we can either accept it or we can do something about it. So I choose the latter, to do something about it and to help women make that decisions for themselves as well.
Well, given that Dollars and Making Sense is all about education, you're absolutely welcome on this show anytime. And I guess you're following in the footsteps of other people that have come onto the show. Friends of mine that are married, divorced women, etc., that have faced their own challenges. Philippa Hunt from Wise Girls Money. And I refer our listeners and viewers to a piece that I did on the show probably about 4 years ago, when KPMG released a report called Addressing Gender Gaps in Superannuation. And that's what we're going to be talking about today, Jen, is around the gender super gap. And there are a whole gamut of things that we can be discussing about, but it's absolutely worthwhile going back. I had a review of that particular report back in 2021. KPMG have just released an update 5 years on, and so it's out now in 2026. It's sad reading, though, because it just doesn't seem to suggest we've come that far along the road 5 years. COVID was a huge impact in everybody's lives, but I think women ended up bearing a lot more of the brunt. Men out there might be scratching their heads going, how? And maybe I could ask you your view on that, Jen, because I know I read many articles about how women indiscriminately suffered a lot more during COVID in home and domestic situations than I think we give credit for. But let's talk about gender super gap. Ladies and gentlemen, Jen has this very good website, a blog. It's jenrichardson.co. And this particular article that I'm referencing today is why women retire with less super in Australia. To the point, I guess, that's what we're just talking about today. So I'll flick back to you, Jen. Why do women retire with less super in Australia?
Predominantly, Ray, it's because of the gender pay gap. So as we know, most of our superannuation is linked to our wages and what we earn because we have the compulsory super contributions. Now, compulsory super didn't come into play until 1992. And of course, it came in at 3%. So whenever our wages are tied to our super contribution, obviously if our wages are lower, which is what the gender pay gap is, that means then the flow on is that we are getting less money go into our superannuation. So the gender super gap ties directly to the gender pay gap. And the gender pay gap exists because women are paid lower wages. We tend to work less hours. We have the gaps when we have our children, but we are also the ones that tend to take time out of the workforce when our parents are aging. So we get hit at both ends with the pay situation that we're in. Now, admittedly, our super contributions are now up to 12%, so we've maxed out where we're going to be. And of course, the removal of the $450 exemption for super a couple of years ago was a great thing for women, because when you're working part-time, a lot of women weren't hitting that $450 a month where your employer had to put in superannuation for you. But the super gap comes about for more than that reason. You know, whenever we take time out of our workforce, so we've had children, we've dropped back, not working, the fees still come out of our superannuation. And if no contributions are going in and the fees and charges that our superannuation fund have are reducing our superannuation automatically. We have reduced hours in the next few years when our children are quite young. And so there's lots of things that will impact us in our superannuation balances. But there's things that you can do also. And so with the superannuation gap, as we get closer to retirement, women will start to concentrate on putting money into superannuation. But of course, as we know, compounding, the eighth wonder of the financial world, the earlier years, the longer that superannuation has to compound. And so you're not only paying catch up with those contributions that haven't gone in, you've also got to then pay catch up with the investment that hasn't earned any money as well. So it's a twofold effect of what we've got to do as we get towards our retirement years to try and catch up. And for a lot of people, that is just too difficult.
Yeah, I got to say, Jen, you've pointed it out, and in your blog here, you use an interesting case of a woman who takes 2 years out at age 32, but you also make the valid point. She misses 35 years of compounding growth of those contributions. That's an enormous impact on the bottom line. And I think people should remember the very targeted, very effective ads that some of the superannuation funds, the big APRA funds, do when they're talking about the difference in fees that are levied and the fees that are charged when you're in your 20s and the impact that it has on that bottom line. I might also point out one of my huge bugbears during COVID was when the then government allowed people to draw 10 grand 2 years in a row out of their super. I was so dark on this because it was robbing themselves at that time, particularly because the unit prices of most super funds were depressed because the stock market took a huge whack because of COVID. And to buy back in is now more expensive, and they've lost those years of investing. And again, ladies and gentlemen, those early years are really, really, really important. And so for all the men that are listening out there, Jen, I want you to start pointing out about kind of things that we can be doing. But before we get to those, because we'll cover those on a bit later in the show, I guess you can't ignore nature. Only women can have kids, okay? I can't do much in that regard. But so what's your answer then to make up for that contribution shortfall?
Yeah, look, and that is the case. And, you and I were talking earlier, Ray, and I have 3 sons, and one of my sons keeps saying to me, stop banging on about this super gap, mum, because, women are always going to take the time out of the workforce. And that is the case. And there is nothing wrong with that there. I took time out of the workforce when I had my children. But what you've got to do is put plans in place for it. So I always say to everybody, start to look at putting some additional contributions in before you have your children. So at the very young ages, as soon as you start working, if you're salary sacrificing into super, that builds that super balance up beforehand. You can do a spouse contribution. So my eldest son and his partner are just about to have their second child, and I keep encouraging my son to do a spouse contribution into his partner's super fund, because you can put $3,000 into superannuation and get a tax rebate of $540 or up to $540, which means that $3,000 going into your spouse's your spouse's superannuation fund will cover not only the charges and things that's going to come out in that 12 months, it will also cover some growth into that fund, which means that it's not just ticking along anymore, it's continually growing. You can also do a co-contribution. So that's where you put in a contribution of up to $1,000. The government, depending on your income, and if you're a low income earner, they will match that contribution by up to $500. Now, that is, again, free money. That's 50%, and there's no tax rate in Australia that's 50%. So any of those free money that we can get off the government is a great thing. And again, it's just there to keep fund ticking along, so that you're prepared for anything. You can also do contribution splitting with your partner. So the compulsory.
We'll get into that in just a moment. We're just about half time at the moment. So you're here on Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone this week Jen Richardson, and she is from, hang on, Jen, name of your organisation again?
JenRichardson.co is my female financial literacy program.
Cool. We're going to take a short break and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone and camera this week, Jen Richardson from JenRichardson.co. She is an ex-financial planner. She also runs a lot of really, really good programs and a lot of, I guess, what I would refer to as community service type of resources that are available on her website. And we're going to give you those links on our blog after the show. Jen, we are talking today about the gender super gap. Now, the pay gap in of itself is obviously something we can be talking about ad infinitum, but what we wanted to talk about today specifically is superannuation, because people may or may not be aware, with 1 July coming up, payday super is just about to be is to come into force. It's something we've known about for quite a long time. But what I wanted to talk about is the numbers in practice. So what I wanted to, I guess, and this is probably more for the men out there, I think the women probably know this already. What does the gap look like in real terms when we're talking about numbers?
So in real terms, women can retire with up to nearly 40% less in superannuation than men. Now,
Say that
that's
again, 40.
up to 40%, yes, less.
Wow.
Particularly the older women, because when superannuation first came in, it was 3%. Men were on a higher income. Men were already contributing to super better than women were before compulsory super came in.
You're right.
Women in the age group 55 and above are the fastest growing demographic of people in Australia that have poverty and homelessness. Women over the age of 60 are more likely to be reliant on men for funding retirement than men are from women. And the gap exists at every single age group. So the superannuation gap, as we talked about earlier, is linked very much to the pay gap. So even an 18-year-old has a gap in their superannuation for females to men. It is certainly better for the younger women because we are getting more education around what needs to add, and it is that 50 plus women that have the biggest gap compared to men. But the numbers in every single age group is showing that women have less money in super than men.
Yeah, I'm reading your blog right now, and it's very specifically saying in the 24 research, women aged between 60 to 64 have approximately 289 grand in super. Men around that same age, 361,000. So we're talking there of roughly 75 odd thousand dollars. That's a big difference. That is a big, big difference. The comfortable retirement benchmark for a single homeowner, according to the same report, should be 630,000. So if you combine them, that's still okay. But the problem is a lot of women, and ladies and gentlemen that have listened to this blog and this show for quite a long time, also come to understand that many, many women, as they come close to retirement, the moment the kids are gone, they're gone as well. And so many, many women will end up divorcing or separating from their longtime partners because once the shackles are off, they are then free to go their own way. They're no longer constrained. I'm curious, Jen, in your own accounting practice and your time as an FP, did you see that as well?
Absolutely. I always say that from my point of view, and I don't know what the statistics say, that I see 60 plus as now the biggest group of women leaving a relationship. And you're correct.
Wow.
It's because they will quite often stay for the kids. Quite often, we don't want our children. And from a mother's point of view, nobody, and I'm very happily married, so I'll say that. But you don't want your children growing up in a split house where they're 1 week with dad and 1 week with mum. And as a mum myself, I couldn't have imagined how hard that was, that you didn't see your small children for a whole week. And so quite often we will tolerate a relationship for our children and then, waiting for them to leave home so that, because of course, all of a sudden one house has to become two. So the home situation, how do you afford to buy a home when all of a sudden that home gets divided up, and we know the pricing of housing at the moment? And so I see a lot of people will say to me, through my accounting practice, when they come back and they're all of a sudden don't have a spouse anymore, and they just say, I looked at retirement and thought, I actually don't want to sit with this person seven days a week, 24 hours. When I was going to work, I got away from them. You come home, you have dinner, you go to bed and everything. And then they just look and go, that's not what retirement looked like for me. I didn't want to be in that situation anymore. So they decided to end their marriage or their relationship. And so what was going to be the backbone of what they had, supporting each other, all of a sudden that's not there anymore. And so there is a shortfall of funding. And, I always say to all my clients when I was talking to them, and particularly when I was doing the financial plan, that it doesn't matter whose name superannuation is. It's a bucket of asset that will get split up when you separate or divorce. And so balancing those beforehand is really important. And, and even if you're in a really happy marriage, it's such a good thing to know that you have looked at things equally, and, the higher superannuation balance is balanced out with the lower superannuation balance where it can be.
You've made some really good points. Now, before we went to the break, we were talking about some strategies that couples can engage in, and we've talked about contributions, co-spouse contributions. Something that I'd like you to cover again, because balancing. So, for example, I mean, I'm very happily married. I've been married 37 years now, but our balances are way out of whack because my wife ended up staying at home. We had challenges with our kids, and it was better for my wife to stay home. Now is the time that we're trying to rebalance. And so I think I'm doing an 85-15 split right now. So no matter what money I put in, 85 of that's going over to my wife's bucket. Because at the end of the day, you're right, it's the same bucket. But I think it gives that feeling of it will never quite be equal. We're trying to balance it up with a whole bunch of other things, but that recontribution. So maybe this is something that, what do people come to you, and is this something you nominate to the ATO?
So it's something that you do with your superannuation fund. So the contribution splitting, and the reason you can only pull out the 85% is because 15% has gone in tax.
Yeah, you've got to cover the tax.
yeah. Tax office don't give that back. But you can move 85% across to your spouse. The other thing, of course, is when you get to be able to access your superannuation, you can always do a withdrawal and recontribution as well.
Yeah.
And I know this isn't for today's podcast, and something that we've got to be careful of is the only place that we have a quasi death tax is in our superannuation fund, where it goes to a non-financial beneficiary. But that's not for today's podcast. It's something.
I've had other people say it very loudly, Jen. I've had people come on and go, "It's not a quasi; it is a death tax." But
it is, but we're not allowed to call it a death tax.
I know, but for our listeners, if you go back to our block, you'll see that there's a graphic there very clearly. I think it's a green shade, but there's a big skeleton there that's is super a death tax, and we talk about that at length. So we have covered that turf, I can tell you. But please, so I mean, they are things, but. I also want to put a bit of a positive light. We've been talking a bit, it's been a bit Debbie Downer, but there have been a lot of improvements since this report done in 21. I mean, you've mentioned the $450 per month threshold. That's now gone. What else has come along that's improved the situation for women in the gender pay gap and super gap?
So the government is now paying superannuation on the maternity leave, so the government-supported one, which hasn't had superannuation paid before. So that one kicked in on 1st of July last year. The downside of that, which, I don't know has come out too much, is that the government's not paying that as you're getting paid. So they're holding off, and they'll pay that after the 30th of June this year, which is a bit of a disappointment from my point of view, because, those contributions could have been in somebody's fund 12 months earning interest, and we know the compounding. And of course, the 1st of July, we have Payday Super come in, which is from a financial planning point of view, and from a person that looks at people's superannuation, is the best thing that has ever happened. So we've had single touch payroll in for a while, which is where the employer has to put in your pay slips, as you're paid. The idea behind that was to try and catch the employers that weren't paying super. Payday Super is now coming in on the 1st of July, and that's where your employer has to pay your superannuation the same day as your wages. And, I'm not sure whether any of your listeners would understand this, but what has happened in the past is your superannuation that was yours on the 1st of July didn't have to get paid by your employer until the 28th of
September.
October,
that's right, yeah.
I was trying to think the numbers through which month we're in. So your employer had your superannuation for nearly 4 months, and that could have been in your fund earning interest, but it also, we always talk about it when you're investing in that time in the market, it will better beat timing the market anytime. Yeah. And so if your money is going in constantly, you'll get some buy-in to investments when the market is lower, you'll get some higher, but of course the law of averages says you get something really good. And so that lets you build your superannuation balance naturally, because all of a sudden those contributions are earning income much sooner. And that is the best thing that's ever happened. The other thing I want all your listeners to know is that it's your responsibility to make sure that your employer has put your superannuation in, because not all employers do. You know, I had a client the other day, he was very young in my accounting practice, and he got me to have a look at his super because he couldn't understand why his balance wasn't going up. Couldn't read it at all. And that's not to say that was wrong. He was only 21 or 22. But his employer hadn't put any superannuation in since November last year. Now, this is May, so 6 months. So well and truly outside the compulsory lodgement period.
Sure.
But, you know, as I said to him, you know, you've now got to chase him, and the government does that. The ATO will chase it on your behalf if you let them know. But hopefully the payday super will get rid of all of those employers that aren't doing the right thing.
Okay, so we've covered a lot in the show. We've talked about understanding your balance right now, consolidating accounts we've talked about many, many times before today. So we've talked about salary sacrifice, co-contributions, spouse contributions. I guess, Jen, I like to leave the listeners and viewers with one key takeaway. If you can give them one key takeaway from today's show, what would it be?
So my key takeaway is always have that knowledge. So look at your superannuation fund. Make sure you're in the right fund. Now, the government will always put out the good and bad funds. So look at what your fees are. Look at where you're invested in, because a lot of people are in just take whatever the super fund puts you in. Now, that can be a bit challenging. You know, the Money Smart website has lots of resources that you can look at. There's your superannuation fund will have lots of free resources that you can look at, but knowledge is power. And so look at what your balance is. Make sure your employer is putting your superannuation contributions in as they should go in. Look at your fees and charges. Are you paying too much? Look at your rate of return. So, you know.
Absolutely. I mean, I harp on my kids, read your annual statements, open it up, because they just look at it and chuck it on the counter in the kitchen. I'm going, no, open it up, read it. You might actually learn something. So look, Jen, I've really enjoyed, you know, this is the first time you've been on our show, Dollars Making Sense. I'd love to have you back. There are just a gazillion things that I see in your blog that we can be talking about. So look, welcome to the show. I hope you'll come back, and we will have many, many more things to talk about. Ladies and gentlemen, Jen Richardson, thank you so kindly for being on Dollars and Making Sense.
Thank you for having me. I've enjoyed every minute of it, because whenever I can preach to somebody and give them some knowledge, I'm in my element.
Wonderful. Okay, until next time, adios.